Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Friday, everybody, and a very happy Year of the Dragon. I hope you've had a productive week and have a restful weekend ahead. It is the holidays in China currently. The country is preparing to enter the new year, but there is still quite a lot to cover, so we should dive in, and today's video will focus on the economy and financial updates. Yesterday, Thursday, the National Bureau of Statistics published the official consumer price index for the month of January, and the numbers were quite shocking. According to the official release, the consumer price index dropped 0.8% in January from a year ago, the fastest drop since September 2009, and much steeper than a 0.5% drop forecast by a Reuters poll of analysts and a 0.3% decline in December. The producer price index fell 2.5%, marking 16 straight months of deflation for factory gate costs. Officials blamed the price declines in part on the Lunar New Year holiday timing effect, and the People's Bank of China expressed the same day in its fourth quarterly monetary policy report that prices should rebound moderately in 2024. But what are the analysts saying? Well, Zhang Jiwei, who's domestically based, president and chief economist at Pinpoint Asset Management Limited, expressed on the news, quote, "The CPI data today shows China faces persistent deflationary pressure. China needs to take actions quickly and aggressively to avoid the risk of deflationary expectation to be entrenched among consumers." End quote. Eswar Prasad, professor of economics at Cornell University and former head of the IMF's China division, sounded more concerned, expressing, quote, "A multitude of indicators are now flashing red, signaling a perilous period ahead for China's economy and financial markets." End quote. Adding, quote, "China's persistent deflation and struggling stock markets indicate that household demand and private sector confidence remain weak, posing significant risks to the economy's growth prospects. As deflation becomes entrenched in China, an increasingly heavy policy lift will be needed to rebound confidence and pull the economy out of the morass." End quote. The deflationary pressures are weighing on corporate earnings and fueling a stock market rout, analysts argue. However, ING chief economist for Greater China, Lin Song, said the impact of pork prices, which have been driving deflation, should moderate in February. Indeed, according to Bloomberg Economics, agricultural goods were at the forefront of this steepest decline in consumer prices, after the fall in food costs widened to 5.9% year-on-year in January, from a 3.7% drop in December. Quote, "Weak aggregate demand is the central issue for policymakers, but ample supply is prevalent across a number of commodities markets." End quote. ING's Lin Song added that increased consumer spending during this year's festival, Lunar Festival, or Chinese New Year Festival, should help push price growth into positive territory this month. We will need to see. We should also note the observations of Peking University Professor of Finance, Michael Pettis, who observed yesterday, quote, "Everyone is focusing on the steep 0.8% year-on-year decline in the CPI in January and worrying that deflation is becoming more entrenched than ever in China. But on a month-on-month basis, CPI was up 0.3%. The second month it has been positive. 2 months don't tell us much, especially at the beginning of the year, and these aren't great numbers either way, as they just confirm how weak domestic demand continues to be. But perhaps the CPI deflation numbers weren't as bad as some are suggesting. PPI is down 2.5% year-on-year and down 0.2% month-on-month, which was more or less expected. For businesses with excess inventory of production materials and excess capacity, this really has to hurt." End quote. Now, speaking of excess capacity, this brings us to the next topic, China's solar industry and global markets. This is part 2 of our coverage of China's subsidized low-carbon industries and global markets. Yesterday, we covered EVs. The European Union has been installing record levels of solar capacity, 40% more in 2023 versus 2022, with the vast majority of those panels and parts coming from China. In some cases, in some countries, 95%, according to the International Energy Agency. This week, US outlet Politico writes that EU solar manufacturers say they now face an existential crisis due to Chinese subsidies, which they blame for flooding the EU with dirt-cheap solar panels and creating a supply glut that is causing a wave of bankruptcies in the EU. Not everyone agrees, the outlet continues, that Brussels should challenge China over its solar practices, however. Quote, given that it might ultimately restrict much-needed solar imports. Others wonder whether emergency cash wouldn't be wasted on a sector that may already be terminal. End quote. The Secretary-General of the European Solar Manufacturing Council, which represents local producers in the EU, told the outlet, quote, the situation is really troublesome. We might lose a majority of the European industry in the next couple of months if there's no strong political signal. End quote. In an article called With Solar Industry in Crisis, Europe in a Bind Over Chinese Imports, UK-based Reuters explains that a flood of cheap Chinese solar panel imports is driving record solar energy installations. But those same imports are crushing Europe's few local solar manufacturers, and governments and industry are split over how to respond. In a letter to the European Commission in November, the German economy minister expressed, quote, I have heard that the Commission may be intending to impose safeguard measures against imports of PV modules from China. I have very strong concerns about this. End quote. Adding in the letter that restricting Chinese imports could, quote, kill off Europe's rapid expansion of green energy and make 90% of the PV market more expensive. It risked bankruptcies among EU companies that assemble and install solar panels using imported parts. End quote. We note, of course, that the German economy is especially exposed to the Chinese market and thus especially vulnerable to a response from Beijing. But it's not just the Europeans feeling pain in this area. Next up, we look at the situation in the US. But just quickly, if you enjoyed today's episode of China Update, I have a huge favor to ask. That is to like and subscribe. This is the best way in which the channel can grow, and for those who want to go the extra mile and help me keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Meanwhile, in North America, the Wall Street Journal writes that during the past year, the world's biggest solar companies, all of which do the bulk of their manufacturing in China, have quietly launched plans to set up or expand panel factories in locations from Idaho to Texas. Quote, part of a rush to build in the US following the introduction of generous production subsidies with the Inflation Reduction Act in 2022. End quote. The outlet explains, quote, China-based companies are behind nearly a quarter of the roughly 80 gigawatts in new solar panel capacity that has been announced since that legislation. That positions them to be big beneficiaries of government subsidies as well, as much as $1.4 billion a year collectively, if the panel factories announced so far are built. End quote. Many of these plants are huge by US standards, the Wall Street Journal writes, and they are going up fast. Quote, at least 4 new factories backed by giant Chinese manufacturers are slated to come online this year, with enough capacity, when complete, to supply more than half of the record 33 gigawatts of panels the US is estimated to have installed last year. End quote. More solar panels are likely to be dumped on international markets too. The industry is so heavily subsidized in China that it's reached overcapacity domestically. UK-based The Financial Times reports this week, citing 3 industry sources, that China is expected to increase curbs on renewable power plant output for the first time in 8 years. Quote, after several provinces said rapid solar and wind expansion had exhausted grid capacity, end quote. And finally, for the economy and for today's episode of China Update, we need to discuss the stock market, which we've been following closely for the last few weeks. Quote, key indexes were all up over 1% on the final day of trading of the Year of the Rabbit. The Shanghai Composite closed at 2,865.9, policymakers' frenzied efforts over the last couple of weeks to stabilize the markets before the spring festival worked. Skepticism is warranted that nothing they have done so far addresses the underlying economic and political reasons for the sharp declines. But policymakers are signaling quite forcefully that they do not want the markets to keep going down, and they will want the year of the dragon to start positively. End quote. On Wednesday, China fired the head of its market watchdog, Yihuiman, a move that analysts said was intended to placate investors angry over huge equities losses. Bloomberg analysts argue that the departure of Yi, a surprise to even high-ranking China Securities Regulatory Commission officials, quote, underscores the growing sense of alarm within President Xi Jinping's government over the speed and scope of the market meltdown that's now entering its fourth year. End quote. Bloomberg News reported that regulators led by the CSRC planned to brief Xi on the markets as soon as Tuesday. There's been no public disclosure yet on whether Xi had that briefing. In a report this week, US-based Goldman Sachs Group estimated that China's national team bought about 70 billion yuan, $9.7 billion in shares over the past month, adding that at least 200 billion yuan is needed to stabilize the market, and observing, quote, government buying might help circuit break the downward spiral, but we think reforms, policy consistency, and plans to address structural macro headwinds are required to re-rate China equity. End quote. Meanwhile, a UK-based Financial Times analysis of data from Hong Kong's Stock Connect investment program shows weekly net inflows of 16.1 billion yuan, $2.4 billion, into mainland Chinese markets as of the market's close on Thursday. A trading desk head at one Chinese investment bank in Hong Kong reportedly told the outlet, quote, a lot of the buying is from offshore state funds. There's also a bit of foreign long-only investors and hedge funds, but they are all linked by the support announcement. End quote. However, the outlet added that traders and analysts said the inflows, quote, also reflected a surge in buying by the offshore arms of state-linked financial institutions, rather than the return of foreign investors. End quote. All of this has earned Xi Jinping a place on the front page of the latest issue of The Economist. Let's examine some of the article. Quote, most worrying of all is that investors on the mainland are also losing confidence. After 3 decades of extraordinary growth, China's wealthy are experiencing a painful reversal in fortunes. Both their property and their financial investments are sinking, and surveys indicate that many white-collar workers received pay cuts last year. The evidence suggests that more capital is flowing out of China. Those who cannot get round China's capital controls are moving into safer money market funds, or fleeing into funds listed on the mainland that The hotel staff just gave me a little toy dragon, I presume to celebrate the year of the dragon that we're about to enter. Let's continue with the quote. Or fleeing into funds listed on the Chinese mainland that track foreign stocks. The real obstacle to change is Mr. Xi's iron belief that he and the Communist Party must be in total control. Regaining investors' trust requires a rethink of the state's role in the economy. But Mr. Xi is unlikely to soften his grip. Investors once thought that China's politics need not encroach on their ability to make money. Now that they know there is no escaping politics, they will tread more carefully. End quote. And on this point, and while we're on the equity markets, one more thing. In an article titled, A 99% Bond Wipeout Hands Hedge Funds a Harsh Lesson on China, US-based Bloomberg writes, quote, from afar, China Evergrande Group had all the makings of a killer distressed debt trade. $19 billion in defaulted offshore bonds, $242 billion in assets, and a government that appeared determined to prop up the country's faltering property market. So US and European hedge funds piled into the debt, envisioning big payouts to juice their returns. What they got instead over the course of the next 2 years is a harsh lesson in the dangers of trying to bargain with the Communist Party. End quote. We end on this observation. Quote, shocking if the fund managers really did not fully appreciate the risk of state intervention and actually thought they would get paid before all the key constituencies inside the PRC were taken care of as much as possible first. And if these fund managers did not understand this, who were they paying for their China advice? End quote. Perhaps they should have watched China Update. I would argue that they would get better China advice, and for free. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Friday, have a great weekend, and I will see you all tomorrow.